All right, good morning. Thanks very much for that nice welcome. So I'm Chris Wilkins, Chartered Certified Accountants. We're registered auditors. We're based in Barnes, Southwest London, and we're Mark and Rob's accountants. Now, what I thought I'd start off today is really just to concentrate on capital taxes. And the main thing I'm going to concentrate is on the autumn statement, 30th of October 2024. If I go back one day, the 29th of October 2024, my tax planning for my ideal client, who let's say he's quite wealthy, so he's got a trading business, let's say it's worth £6 million, and let's say he's got a pension fund worth £1 million. So this is pre the budget. Now, the beauty about that situation is when the guy died, the plan was that the pension would be left to his kids on the assumption that his spouse has enough money. So the pension could go straight to the kids and not be subject to inheritance tax because it's out of his estate because it's in a will trust. His shares in his £6 million business could also go straight to the kids, and you claim something called business relief, previously called business property relief. The thing for farmers is agricultural property relief that you may have seen, but the theory is just the same. So in that scenario, his £1 million pension fund is out of his estate, no inheritance tax payable, and his £6 million shares in his trading business are also out of his estate because he claims business relief, previously business property relief. However, unfortunately, since the 30th of October, that climate has changed dramatically. Now, what you've got for inheritance tax is you could say, well, I've read in the paper that my wife and I can have about £1 million in relief because we've each got a inheritance tax exemption of 325,000. And that's a transferable relief. So if I died today and left all my money to my spouse, she gets my £325,000 exemption, which means her exemption is £650. Then there's the residence nil rate band. The residence nil rate band is £175,000 and you get that each. So you could say 325 times 2, 175 times 2, £1 million. Great. So the only problem is the residence nil rate band, you can only claim it if your assets are less than £2 million. If they go up, it gets reduced by £2 for each pound you've earned over 325. So therefore, the maximum, if your assets are more than 2.35 million, you lose the residence nil rate band. So the problem is that from the 30th of October, pensions are now subject to inheritance tax. If your pension is £1 million, then you basically lost your residence nil rate band. So that takes you back to an exemption of £325,000. So then the question is, what do I do? Because I've still got my £6 million business. And my £6 million business now, I'm only going to get business relief plus agricultural property relief is maximum of £1 million if you've got two of those assets. So that means that you've got a maximum of £1 million. So my £6 million business, broadly, the first £1 million will be free from business relief. The next £5 million are subject to 20% inheritance tax, plus my pension. So my plan prior to 30th of October for my clients is they leave the pension to their kids on the assumption that their spouse has enough money, and their kids pay income tax on drawdown because I get tax relief when I contribute into a personal pension. So I put money into a personal pension and I get tax relief. So one of the tax planning schemes you may have seen, it's not a scheme, but say I earned £160,000. I go to my accountant and I say, look, I'm going to earn £160,000 this year. How can I save tax? They say, well, actually, if you put £60,000 into a pension, you've got £160,000 PAYE salary on your P60, less your pension contribution of 60, you're only taxed on 100. So happy days. But I'm getting tax relief on that 60, and I will have throughout the whole of my life. So we've got clients that are 80 and had tax relief basically for 50 years. So the quid pro quo is you get tax relief going in, and then you pay tax on drawdown coming out. But if I leave it to my kids, the idea is that they may be relatively young, depending on whatever age you die, but they will draw it down and they'll pay income tax at their highest rate of income. Now, it may not be 45%, but the chances are that as you get older, you're likely to be a 40 or 45% taxpayer, so you're getting higher rates of tax relief. So the idea then is they may be drawing it down and paying low rates of tax. The problem you've got now is that you can't give your pension away. You can't just say, you can have it, which means that upon your death, that pension will be taxable. So if this legislation comes in April 27, so let's assume that I've got £1 million under my pension. I say £1 million because the pension limit was raised by Jeremy Hunt in the March 24 budget. And so there is no pension limit now. But if you want income tax, if you want the drawdown, the first 25% of your pension can be drawn down tax-free. And that 25% is limited to a pension limit of £1,073,100, a number that trips off the tongue. But you can take that out tax-free if you've got that much as a sum. So that's like £268,000 at the moment you can take out tax-free. So the problem then is that this client who's got £6 million of shares in his business is valued at £6 million, and he's got £1 million pension, how is he going to distribute his assets such they're not all going to be subject to inheritance tax? So let's see if I can do the next one. Right, the shares in your trading business or the value of your partnership sole trading business are currently free from inheritance tax. From the 6th of April 26, it's limited to £1 million. So thereafter, anything above that £1 million, so in this case, the example, the client who's got the £6 million business, the first £1 million will be free for inheritance tax under business relief. The next $5 million will be subject to 20%. What we've got here. Right, so just before I do that one, can I just have a show of hands who's got a will? Great. And can you leave your hand up if your will says you're going to leave your pension to your spouse? Well done. Okay, so that's great. So number one, you've got to have a will. I had a client that came to me and I said, have you got a will? He said, look, Chris, it's 90% there. I just got to swear out. I said, sign it. He said, what are you talking about? I said, look, sign it today, it's 90% there, but you don't want to die intestate. You need a will. Everyone's got to have a will. However, if you died after the 6th of April 27, then that would mean that your pension would be part of your estate, and therefore that would be subject to inheritance tax. Anyone got an idea what the maximum rate that you could end up paying on the pension for upon death if you died after the 6th of April 27 with a pension fund of £1 million? What's the maximum rate of tax that could be paid on the pension fund and on drawdown? Any ideas? 55 we got here. Any other takers? 45. Any others? More. So the highest number could be 67%. And the way it could be 67% is this pension fund that I've got of £1 million, I leave it to the kids. Therefore, that's subject to 40%. And the way the new rules work is that the pension fund pays that money. So they don't give the kids the million, they take the 40% off that. So that leaves 600,000. The kids then have to take it down, they draw it down. So if your kids are high rate taxpayers, you've got 45% income tax being paid on the 600,000 because it's already had £400,000 deducted. So let's just go to this one. So what you've got here is you've got a pension fund of 500,000. Upon death, the only way around this is if you leave it to the spouse, which is why I asked. Because if you leave your pension fund to your spouse, this has got spousal transfer, which means that if you leave anything to your spouse, no inheritance tax. You've got to be slightly careful though, because I had a client and I said, have you arranged all your tax affairs? He said, don't worry, it's all sorted. I'm never going to pay inheritance tax. And I said, well, how are you going to do that? He said, well, I'm going to leave it to my wife, so I'll never pay it. I said, yeah, but what about her when she dies? I mean, someone's going to pay it unless you give it away. So the point is, what you've got to think about is how are you going to address this? So guy dies, £500,000, and pension fund will pay 40% tax on the 500, which is 200, which leaves you with 300. You're then subject to income tax because you've had income tax relief. Say it's the parent who leaves it to the child. So the parent has income tax relief on putting the money in against their income tax liabilities. Therefore, the person that draws it out, perhaps the child, is subject to income tax. So if I've got a salary, let's say, in this scenario, that means I must have a salary of over £125,000 because that's the rate upon which you pay inheritance, 45% tax. So therefore, I'm drawing down the pension. So the pension drawdown is subject to income tax on me. And I've already got a salary of 125,000. So I'm going to be a 45% taxpayer. So the point then is that means you've got an effective tax rate of 67% because it's the £200,000 plus the 135,000. So what you've then got to do is think about, well, how are we going to sort this out? How are we going to address this? So you might say, well, one thing I'd probably want to do is reduce my estate. So I could, as an example, start drawing the pension myself. The only trouble is I'm a 45% taxpayer because at a certain age, you might be 40 or 45% because you're getting on, you've built up assets, you've got rental income, whatever, you've got salary. So the problem then is that whereas the assumption that the kids may have been low rate taxpayers, you're going to be drawing it out. So I've got a client who's 80. He's got £3 million in his pension fund. And he said, what am I going to do? I don't want to pay 40% tax on death. So I said, well, there's two choices. You either spend it or give it away. But either way, you've got to draw it down. £3 million in a pension fund, 100 grand a year, that's 30 years. He ain't going to live for 30 years if he's 80. So that means bulk of that is all going to be at probably 45% tax. So income tax is going to rocket because everyone's got to draw down their pensions. And then what happens is that I talked to a client, he said, I'm too young to sort this out, I'm not interested. I said, okay, just wait a minute. Say it takes 7 years to draw down your pension, you've then got to give it away and you've got to live 7 years. Well, that's 14 years straight away. How long are you going to live for? So you've got to sort of start planning this stuff sooner. The other thing you've got to think about is, well, what else can I give away that's better than others? So there may be some things that you want to give out away sooner rather than later. Now, I've got a client who's got a property. So we're based in Barnes, Southwest London. He bought it in 1990. That property in 1990, 35 years ago, cost him £150,000. It's now worth £1.75 million. That means he's got a gross gain on the residential property of £1.6 million. The new rate of capital gains tax went up 20%. So it was 20%, it's now 24%, and that kicked in. So that means that he's going to pay 24% on £1.6 million, which is about £400,000 capital gain, if he gives the property to his kids. That's a dry tax charge. It's a dry tax charge because it's a gift. He's not getting any money. So he's then got to find that money to give, to pay to HMRC. What else could he do? Number two, he could say, I'll tell you what I'm going to do, sod it. I'm not interested in any of this. They can all sort out when I die. Well, the only trouble then is that upon death, the 1.75 million is all going to be subject to inheritance tax at 40%. Because inheritance tax, A, it's a higher rate than capital gains tax, and always is. Capital gains tax only came in on only 6th of April 1965, but it's always been historically lower. So the other thing is capital gain is a gain on the asset, i.e. the capital gain is assessed on sales price less cost. Inheritance tax is market value at death, irregardless of how much it cost you. So it's 40% on a higher number. So 40% of 1.75 million is 700,000, and that's going to be payable out of the estate. So the reason that farmers are up in arms is because they've got a farm. They can't just go and sell a bit of the farm and say, have that bit. However, if you can claim something called gift holdover relief, there's more ways of mitigating it. So what you want to do is like this client who's got shares. He's got shares in a trading company, farm, if the farm is trading, it's got to be trading. So if I buy a farm for 20 million and say, I'm going to carry on working as an accountant, but I'm going to let someone manage it, that's not me trading. That's me renting it out to someone who's managing it. So it's got to be a trading asset. The trading asset, you can claim these reliefs. But what you might want to do is start giving chunks of your trading business and your farm or whatever your asset is, as long as it's a trading asset, start giving it away now and live 7 years. If you don't live 7 years, you pay capital gains tax and inheritance tax, or If you do it right, you don't pay any capital gains tax and you don't pay inheritance tax. But obviously, it's difficult. The way the legislation's done is that it may have kicked in at the wrong time of life. You might be a bit old and think, I ain't going to live another 7 years this rate. Or I haven't got a spouse to leave the farm to, or I haven't got any kids, or whatever. So there are going to be problems. But you've got to think about this stuff, and you've got to make sure that we've sorted it out. So let's see. Here's a nice, easy one for you. So what you need to do is you need to think how we can make this work. So there's something called gift holdover relief, which says that if I've got my £6 million company and I want to give shares to my kids, I will give them my shares. Now, there's obviously going to be quid pro quos in this. You might say, well, the kids are too young. So I'll have to change the shareholding so that I can have the majority control, but I can get rid of a chunk of it. I might change the classes of shares to make sure I've got control. But I want to divest my estate by as much as possible. And by divesting my estate, if I live 7 years and give them the shares, I claim gift holdover relief, which doesn't crystallise capital gain on me. So what that means is that £6 million business, and I started up with my wife 30 years ago, and the shares were £2 each. So that means that the kids acquire my shares at £2, which means that when it's sold, they pay the capital gain, not me. So what you're doing is you're passing it another generation, but you are avoiding inheritance tax. And you're avoiding inheritance tax by claiming gift holdover relief. Now, there's another thing that was changed in the budget. Well, I'm concentrating on inheritance tax. The other thing is capital gains tax. Capital gains tax was changed. We used to claim something called business asset disposal relief. Precursor of that was entrepreneurs relief. Entrepreneurs relief, the first £10 million of gain, I only paid 10% capital gains tax on. BADR, business asset disposal relief, the first £1 million, I get 10% on. I only pay 10%. Now, from the 6th of April this year, it's 14%, and next year it's going to be 18%, but the main rate of capital gains tax is 24%. So, there is a small window where I actually can claim, as the owner of the business, a lower rate of capital gains tax. Now, you could say, well, I'll give it to the kids and they can claim it. But the way you claim business asset disposal relief is you must be, A, it must be a trading company. B, you must own at least 5% of the ordinary shares. C, you must be a director or an employee. So, I can claim it because my wife and I own 100% of the company. However, can the kids claim it? Because if they can't claim it, that whole relief is lost. So, in a funny way, with this particular client, I might get them to pay tax, but I'm going to tell you why I'm going to get them to pay tax. So, A Limited is a trading company. Gwyn Smith and Rob Smith are married. Gwyn owns 5% of the company and Rob owns 5%, so together they own 10%. Gwyn's shares cost £5 and they're now worth £1 million. Rob's shares cost £5 million and now worth £1 million. Sorry, cost £5 and now worth £1 million. Gwyn is a company employee. Rob is the company director. Gwyn's 64, Rob's 67. They both want to continue other work. They've got other assets for 1.5 million. They've got 3 kids. And what they're going to do is they're going to give the shares to the kids equally. Given what I've just told you about BADR, will the kids qualify for BADR? Because? Exactly. So that 10% shares, i.e. Gwyn has 5% of the company, Rob has 5%, and the kids will have 3.33% each. So they could never qualify for business asset disposal relief, even if they became employees or directors of the company, and it was still a trading company, and they kept their shares for 2 years, which is the rule, it's got to be 2 years. So in that scenario, Gwyn has other assets and Rob has other assets. So then you might say, well, how about mum and dad not claiming gift holdover relief and actually claiming BADR? Because BADR at the moment is 14%. They still save 10% tax because the standard rate of capital gains tax is 24%. they can get it at 14%. They've got a small window, got to be done before the 5th of April next year, because then it goes up to 18%. But you've got a window. And then they could pay tax on that rather than the kids. Now you could say, well, this is a dry tax charge. I'm giving it to the kids. So that means I'm not going to get any money back. So where am I going to find the tax? Well, they've got private pensions of £1 million each. So at the moment, they can take 25% of their pension because it's less than £1,073,100. So they can take 25% tax-free. So they can grab that now. That gives them £500,000, £250 each. So what I'm saying, it's not, you can't, when I discuss this with clients, you can't always say, look, don't worry, no one has a magic wand. You can come up with the best scenario for them. In this case, the best scenario is they can get out of that at 14%. If they wanted the kids to have the shares and claim gift holder relief, you can do that, but then they're going to have a massive tax bill at 24% at least at the moment, and probably rising. So when you do this, you sort of got to have a look at how it's going to work and how you can sort of make it go forwards. So with a lot of the stuff is you'll probably find that your affairs are more myriadical than you thought. And the idea is that we're all getting to a certain age now. Add on 7 years, you've got to live 7 years after you've made the gift, or otherwise you pay inheritance tax and capital gains tax. So you've got to plan. You've got to get something in place. I'm always amazed at how many people say to me, Chris, can I put another £1,000 through for income tax? It'll save me 400 quid. But they never think of the £1 million they're going to be paying on inheritance tax. Inheritance tax seems to be this thing, well, someone else will sort that one out. You don't realise how big these numbers will get if you don't plan it. You might be saving a bit on income tax, but this will crucify the estate if you don't plan for this block properly. So then you've got to think of, do I need to live 7 years? Well, I'm not a special case, but I don't need to live 7 years, and I'll tell you why. The reason is there's something called gifts out of income. So I work full-time. If I drew down my pension and I made regular gifts of that income to my kids, it doesn't affect my standard of living because I've already got a source of income. That means that as long as I make regular gifts, it's gift out of income because that pension doesn't affect my lifestyle at the moment because I've never had it before. So as long as I make those gifts out of income would mean that you could justify not living 7 years. And then if the worst happened, then hopefully those gifts will not be subject to inheritance tax. You need to plan, you need to record it properly, but if you were going to do that, then the problem most people have got is you've got to start drawing down your pension because of the legislation that's going to come in on the 6th of April 27. There's an HMRC sheet that you can put it down on. So what I thought I'd do in the last few minutes, I'd just give you a head start on what Rachel Reeves is going to do this autumn. Now, if you go back to last autumn, 30th of October, the Chancellor raised £40 billion, of which 25 billion was employers' NI. And what you've really got to bear in mind is that the people that pay the cost, employers' NI, employers, aren't the ones that necessarily bear the costs. And so PricewaterhouseCoopers said, this will cost us £40 million as a firm. We're going to outsource jobs. We're going to use more AI and we're going to make redundancies. The problem with that is this country has low growth and low productivity. Our government debt is about £2.8 trillion. Our spend is about £1.23 trillion, which is about 98% of GDP. We've got no wriggle room. Unless we can get more growth and more productivity, we're in trouble, irregardless of what's just happened. In that budget, she said, I've got £9 billion spare just to sort out eventualities. But to give you an idea, £9 billion at the moment is about a month's interest on our debt. Our debt is costing us about £108 billion a year just to pay the interest, not the capital, just the interest. They said that if Thames Water has to be nationalised, that will cost us £4 billion. So that'll give you an idea. My own bugbear, non-domicile tax, they reckon that would cost £12.2 billion by the people exiting the country. So what that means is that without a doubt, there's going to be more tax rises. And the tax rises have got to be in the billions to touch the sides. Now, they've already said, so the tax raised in this country is about £858 billion a year, of which 75% of that is income tax, national insurance and VAT. The trouble is, they've already said they're not going to touch income tax, national insurance and VAT. They're not going to increase it. VAT brings in about £170 billion. Now, what you've got to bear in mind is that I think Chamberlain said there's lies down lies in statistics. So you might not increase the rate of VAT, but what else could we do? So the VAT threshold at the moment is £90,000. And you could say, well, how generous is that as a country compared to the rest of Europe? In Spain, the first €1 is subject to VAT. In Germany, Netherlands, Belgium, Portugal, the maximum rate is about €25,000 before you need to be VAT registered, as is by far the highest rate. If that means that your average salary here is about £34,000, so if I'm a person who doesn't have many direct costs, say window cleaner, plumber, electrician, I could earn up to £90,000 and not charge VAT. My competitor down the road who's got a turnover over £90,000 will charge 20% more because he's VAT registered. So if I'm dealing with the public, general public, they're not going to be VAT registered. So that means that suddenly my charges are going to be 20% more expensive. So people try and stay within the £90,000 who are in that band because they've got very little direct costs, very little input VAT anyway, but it means that they don't have to charge 20% more. So you could say, well, how can the government make money out of that? If they halve the VAT threshold, say from £90,000 to £45,000, that'll bring in £1 billion. One of my clients told me that there's an article in The Guardian that said exactly that. But if you go back to our website 6 weeks ago, I did a lecture on this, and most of the ideas, The Guardian have obviously done the research on my website, so they like it. So that's number one. Number two, how else could you raise money? The number two is that let's go back to the guy who owns the property. Residential property cost £150,000. It's now worth 1.75 million. He could pay capital gains tax if he gave it to his kids today, pay inheritance tax if he died. Number three, he could use a spousal transfer. Spousal transfer is he leaves the property to his wife. That means that under the spousal transfer, her deemed acquisition cost is the market value of the property at the date of death. So at the date of death, the property is worth 1.75 million. She then immediately gives it to the kids. No inheritance tax, no capital gains tax as long as she lives 7 years. That little trick cost about £1.6 billion. So that's one that they might get rid of, the spousal transfer. So the spousal transfer has already got an uplift. So that's one that they could make a lot of money on. Number three, I never thought that they would do what they did with pensions, but they're so short of money, they need it. What else can they do to make money out of pensions? Well, there's a number of things. They could restrict the tax relief, or they could restrict the 25% tax-free on the 1,073,000. So the first 25% of your pension up to 1,073,000 is tax-free. If they say took that down to 100,000, so that means out of the 268,000 you get tax-free, 100,000 is free and 168 is taxable. 168 would all be taxed at 45%, and that's £2 billion. So that's three things that's going to bring in nearly £4 billion. If they wanted to be really aggressive, the next thing they could do with VAT, like I say, VAT, income tax, and national insurance are the big tax ways you raise money. 75% of £858 billion is what that brings in for the government. So how about all you people who are interested in, is a Jaffa cake vatable or not? That's the sort of the classic thing where is it a cake or a biscuit? You could widen the VAT base And there's lots of things that are exempt from VAT. We've got probably the most narrowest VAT base in the European Union. So there's loads of stuff that you go to most other countries and it's VATable, it's not VATable in the UK. If they wanted to do that, that is far in excess of $1 billion, depending on how aggressive they are, but you could widen the VAT base and you can make lots more money out of it. So it's quite considerable what they could do. They've got to do something. And then the question is, how can you get around it? So if you think that the government would tax some or all of that 25% tax-free on your pension, and if you thought that, you'd be taking your pension money out sooner rather than later, certainly before this autumn's budget. So you'd access that money, you'd take it out. That means, say it was £268,000, if you put that in the bank, that's going to be subject to income tax, invest it in shares, it's going to pay dividends. Then you want to decide what you want to do with it. Do you want to give it away? Do you want to spend it? But what happens is that I think if you don't do anything, that chances are that it's going to be taxed higher. So you've got to be sort of proactive with this stuff. You've got to be proactive with capital gains tax, with inheritance tax, VAT. You've got to assess, talk to your accountant, your advisors. You've got to look at your assets and think, what's the best way of doing them? Because whatever happens, the tax horizon will get dramatically worse. That's irregardless of what's happened this week. What's happened this week just makes that situation even worse. So you've got to sort of think about your affairs, think about how you're going to plan it, and then act accordingly. But if you do think sort of like, I've got time, generally you haven't, if you think 7 years plus 7 years. If you've got a big lump sum pension and you want to draw it down, in this case, the client has got £3 million, that'll take 30 years, 100 grand a year, and then you've got to give it away. I'm not saying that people have got figures that big, but whatever it is, you'll find it's quite large. And if you don't do anything, it's going to be taxed. And if you thought, well, I haven't got time, then a short-term measure is change your will, leave your pension to your spouse, whatever quantum that is, then at least it's protected, and hopefully your spouse has a few more years of living. But you've got to think about this stuff because the numbers are pretty large, and you've got to sort of make sure that when you do it, that you plan. And I've got a horrible feeling that it's just the tax horizon will get dramatically worse this autumn because we're so far behind, because we owe so much money. Sorry.
Regardless of how they do the tax rises, they might do it any which way. Some taxes will affect some people, taxes will affect another group, but ultimately they don't care, they just want to get more tax in to pay.
The question has been asked, what will be the effect on the economy if the government continues to increase taxes?
So, if you go back a century, the rich people were generally mill owners, say in Yorkshire, and therefore they'd be stuck in the UK. What you've got to bear in mind at the moment is that the top 1% of taxpayers pay 29% of all tax. And the top 1% of taxpayers are peripatetic now. They're not generally tied to the UK. And they've got laptop and will travel, which means that they can go. So the press assume that if the domicile tax kicks in as dramatically as it can, the government could lose £12.2 billion. So people leaving. So to give you an idea, Jim Ratcliffe left, for those of you who follow football, he's Man United. Those that follow chemicals, it's Ineos. He left, I think, in 2018 to go to Monaco, not going to pay any income tax in Monaco, and he was paying, I think, £108 million a year in income tax.
So all the tax rises the government's doing will simply make things worse?
Yeah, because what you're doing is you're alienating the people that pay the tax. So if you look at, say, the Livingston brothers just left the UK, they pay £104 million a year in income tax. Average salary is £34,000, so that means that 21,500 people on an average salary have got to suddenly appear to pay that much tax, and it just ain't going to happen. So,
need more tax to pay off all the debt and the spending.
yeah, I mean, our debt at £2.5 trillion or £2.8 trillion is so large that, like I say, the interest alone is £108 billion a year just to pay the interest. So we've not got enough money coming in. And that's why, I'm not getting into politics, but there's only really two ways to make this thing balance. You've got to reduce your costs or increase your tax. That's or borrow more money. That's sort of those three. Now, we're at 98% of GDP, so I don't think there'll be a big queue of people lending us money, and interest rates are going to go up on the basis of that. So we're in a pickle.
So it's not much different to.
So it's not too different from an individual getting themselves into debt.
Yeah, your debt markets will just charge you more interest.
You can't buy your way out of it, so it's reduce costs or raise taxes.
Yeah, so if you think that we have never, as a country, we've never paid as much tax since the Second World War. However, it's also true to say that your average employee has never paid as little tax. So when I say average employee, that's someone who earns £34,500. That person is probably paying about £5,000 tax in NI a year. Your average person in the UK, if assuming they're not claiming any benefits, costs the government about £20,000 in services. So unless you're paying £20,000 in tax, you're not even breaking even. If I'm earning £60,000, I'm probably paying £15,000 in tax in NI. And when I'm £70,000, I'm paying about £20,000 tax. So until I'm doing that, I'm not even breaking even, which means that you're relying on the top 1% to pay all the tax. So if the top 1% are leaving, and then you think, well, wait a minute, what more tax could we do? So anyone got an idea what the real rate of capital gains tax is? The real rate. Let me give you an example. I buy an asset 10 years ago for £100,000. I sell it today, 10 years later, for £150,000. My gain is £50,000, tax 24%, £12,000. However, 10 years ago, the inflation of the last 10 years is 35%. So that means in real terms, you used to have indexation for capital gains tax. You don't have it anymore. So my £100,000 in real terms is actually worth £135,000. I sell it for £150,000. I've made £15,000. That's nearly 100% capital gains tax because there's no indexation. So the problem you've got is, Mark will tell you that if you have debt, indexation will erode the debt. But conversely, if you've got an asset like that, you're not getting indexation relief.
It's almost pushing us into debt.
So
debt erodes.
The rate of tax you've got at the moment, there's loads of hidden taxes. So the rate upon which you pay 45% income tax is £125,170. Beneath that is 40%. If I earn £120,000 today and £126,000 tomorrow, do I pay more tax or less tax?
Oh, there's a big step, isn't there? £100,000 for a couple.
Between 100,000 and 125,140, I'm paying 62% marginal tax. 62. You don't see a rate of 62%, but the reason it's 62% is because if you earn more than £100,000, for every £2 you earn more above it, you lose your personal allowance by £1. So when you get to double the personal allowance, £12,570 times 2 gets you to 125,140. In that bracket there, it's a 62% tax bracket. There's loads of these things you don't even see the tax rates like that. They won't be written down anywhere.
So between 100 and 125, you won't earn any more, regardless of what your salary is.
So if I earned £126,000, my advice to a client might be, if you've got £26,000 spare, put £26,000 in a pension, and suddenly you've reduced your taxable profits down by making pension contributions. Well, the only thing about that is don't forget it's accumulating gross. So if I am a 45% taxpayer, basically £100 of pensions cost me £55, and it's growing on 100. So that's tomorrow's problem. Today's problem is I don't want to pay income tax. I mean, that's the sort of way you're doing it. But then you've got to think, well, how do we deal with tomorrow's problem? Well, no, I'm not going to. So I think that would be a dereliction of duty for my kids if I said, well, they can sort it out, because those figures can get pretty big. So, yeah. So, sorry, I know we've got some questions coming up. Mark, I don't know if you want to, do the questions, or I just carry on, or how do you want to do it? Because I know Mark was had some questions as well. Carry on. Yeah, okay, yeah. Sorry, next one. Yes, sir.
Following on from that, with a SAS, if your children are trustees and then you subsequently die, what happens then?
Well, if they're trustees, I don't think that makes any difference to that, but I think you're still going to have the same problem. Because the way the legislation is set up is that they're all going to be subject to 40% tax. I mean, the plan is either you take it out and spend it, or you take it out and give it away. But either way, by taking it out, you're going to crystallise the income tax charge. Yeah. So that's the sort of the issue you've got. You've got to think about your timing of all this. Now, if I decided I want to draw down my pension, I might try and reduce my other forms of income somehow by making more gifts. If it's a dry tax charge, if I got property and I give it to my kids, then that will crystallise capital gain.
If you make a gift, how are they taxable?
So it depends what it is. If you make gifts on this article, I would claim gift holdover relief if I want to, in which case it wouldn't crystallise a tax charge on me or them. If I wanted to claim bad R, because I know that bad R at the moment is 14% and they would pay 24% because they're not eligible to claim it, then depending on my financial position, I might say, well, actually, I'll take the hit for them and I'll pay the 14% because it's cheaper than them paying 24% when they sell the shares in a few years' time. And when they sell it, it might be even higher. Yes, sir.
That's a quick one.
Yeah, sure.
Two things. One, Mark, thank you for introducing us to this encyclopedia. It's amazing.
Tax reducers and trusts. How much of that work do you do?
Tax reducer? Well, so venture capital trust, basically you're going to get 30% income tax relief as a tax reducer. That's how that will work. And then, sorry, are you talking about an inheritance tax angle?
No, I'm talking about the benefits you get from tax by giving free payments.
Yeah, I mean, so you could, if you hold the asset, EIS relief, SEIS, VCT, hold it for long enough, you don't pay any capital gains tax. The question I sometimes have with clients is, do you want to make the capital gain, or do you want your kids to make the capital gain? Because you're just going to have more money, and if you've got enough, then you're going to have more money, and then you've got to think of giving it away before. Okay, so it's a case of, well, some people say, okay, I'm going to set up a company with the kids.
With VCTs and EIS, I find the returns are often not great. I've got both. I did both probably, I think this tax year or last tax year. And I've done them over a number of years. And there's VCTs, they're funds. So Octopus, there's a few other quite big ones. But if you look at the historical returns, they're always quite a bit less than. So it's sort of difficult. SEIS or EIS, you might have a friend or know someone who's got a startup. I've just been offered some seed investment in a friend's company that he's starting. And if it's SEIS, if he loses all the money, the company goes bust, or I lose all the money, the maximum loss is 30%. But of course, deep down, what are the chances of him succeeding? Honestly, yeah.
So the idea used to be that you could invest in some of these trusts through the AIM market, and the AIM market used to get BPR relief, and therefore they priced the shares accordingly.
VCTs and EIS, there's no IHT. Someone said 2-3 weeks ago, I had a call with Schroders, and they seemed to suggest there was some IHT relief, which I'd never heard before.
I'm not aware of it.
No, I got the feeling he was wrong. Yeah,
I mean, unless
sounds
it's
like he is.
in
Yeah.
a trading company. Is he saying you got shares in a trading
No,
company?
it was a VCT or EIS.
Okay.
Yeah.
Well,
It doesn't sound right, does it?
no, I don't think so.
No.
Thank you, Michael. How much do you trust wise?
So Chris doesn't really like trust because every 10 years you have to give HMRC 6% of the value of the equity in the trust. And I've sort of broken it back, and I think that some people might say, oh, well, just give them 0.5% every year. Do you know what I mean? Over 10 years, and that probably gets to about 6% if you compound it. But
I do a FIC rather than a trust.
Yeah, go on then.
Family investment company rather than a trust. I do it that way. So, say for the sake of argument, I cash in my shares and I got £1 million, and I think, well, I got to get rid of that, but I'm not going to give the kids £1 million because I don't want to spend them on fast cars. And then, so what I'm going to do is set up a company, and the wife and I'll have a share each, and the kids can have 98% of the shares. But I'll have my wife and I'll have voting shares. They have non-voting shares. Stick the £1 million in, and then we'll do something with the company. But I've divested my estate. So the point then is I've still got some measure of control over the company because I've got voting shares, they haven't. And then at a later stage, I might decide on sort of passing voting shares over when I think they're old enough to have some influence in the business, run the business, but it gets them going. And I've sort of tackled my inheritance tax problem.
The other thing with trusts is you have to pay the top rate of income tax. You have to pay 45% on everything. So you don't really like them, do you?
No.
Some people do. I think because it's 6% of the equity you have to pay every year, not 6% of the profit. Yeah, so it's it's a capital charge. I just sort of overlaid it over one of our companies and worked out what that would be, and that would be a little bit like paying corporation tax at 35% instead of 25%. So it's quite a big hit, isn't it?
Yeah, I mean, if there's two main reasons you do it. One, I've got some people who worry about the bloodline. So they have money in the trust and they say, well, I want it in the bloodline because if my kids get divorced, I might lose it. But what you can do is with a FIC, you can have your shareholders agreement to make sure that you have poison pills in your shareholders agreement. And the great thing about a FIC is that you don't necessarily have to take any income out. If you want to take dividends, you can. But then you only pay dividends at the time that you choose, which means you only pay tax at the time you choose. Yes, you will pay corporation tax at the rate of 25% of any trading profits, but it may be investment assets you've got in there. But what you've done is you've mitigated your inheritance tax liability, and you can control to some extent where it goes with the FIC, where the assets go. Yes, sir.
What's the best time to claim relief using BADR?
Well, BADR has got to be a trading company. So if you say it's an investment company, you probably fall at the first step. So you've got to make sure that you actually conduct a trade. If it's passive income, it's unlikely to get business property relief. There's been a number of cases where people have rented out properties and they provided additional services. So the question is, if you look on the spectrum of what am I doing with my property, if I run a hotel, that's a trading asset. A guest house, a trading asset. Passive rental income, no. But how do I move it forward? If I provide other services, such as I arrange holidays for people, things like that, there's one case I know where they've won it. All the others they've lost. So you've got to move your business further away along that scale to more like a bed and breakfast or something. You're conducting a trade rather than receiving passive income.
Well, what about if you mix assets in there? So you've got some investment assets, but then you've got a trading business. How does the sort of allocation or the percentage work?
So the way it works is you look at turnover, management time, and balance sheet assets. So you've got to make sure that with two, basically, of those three, you want to make sure it's more a trade than an investment.
So is there a percentage, i.e. if a third of it was investment, the whole thing would qualify, or does it not work like that?
Well, it used to be 80-20, where it had to be 80%, but there's a recent case law that's changed that.
What does that say?
It's less. I think it's less than that.
i.e.
You can have more investment income than trading. It used to be.
Oh, well, that's quite good, isn't it?
It's good, but there's
You don't know
obviously
what.
a few boxes to tick.
And you don't know what percentage, because as usual, it's clear as mud. They've just not given you one. Yeah.
One of the things I always find quite funny is that you look at case law. So stamp duty land tax. So if you think of stamp duty land tax, if I bought a property, let's say I buy a property and it's got a load of farmland with it, I'll say, okay, well, the property, the residential rate of SDLT is just the house, and the farmland, I want commercial rates, so I want to pay less tax. And they say, no, the whole thing's a house. Okay, it's a house. Then you come to sell it, and you pay capital gains tax. And you say, well, it's whole house, because they told me that when I bought it for SDLT. No, you only live in that bit. And so the two taxes are fighting each other at the moment. They don't make sense. But you look at the case law, and you say, well, wait a minute, how can you get away with that one and not that one? So there's all that type of argument at the moment.
There's a lot of this anyway. Planning is different, taxation is different, building regs is different. You've got to argue each one according to what sort of benefits you.
And find the right cases, not AI cases.
And VOA, council tax or business rate, it's all its own little bit, and it doesn't necessarily follow.
Yes, sir.
I have a couple of questions. Great insight, thank you. This may not apply to everyone, and if you're someone who's doing stocks trading. So my first question is, if you invest in stock, let's say you've got £40,000.
My question is, let's say you've got £250,000 and you don't know what to do with it. So you stick it in an ISA. Am I correct in saying you don't pay tax regardless of what income you earn?
The second one, what are your thoughts on this? Do you think that's the right route to pay tax on the gains?
So an ISA is, by virtue of the ISA, it's exempt from income tax and capital gains tax. Upon death, though, you have to realise it, and it's going to be subject to inheritance tax.
But if you give it to your wife or your spouse, it can stay, the ISA wrapper can stay in situ.
3 years.
And you don't pay, or she or he wouldn't pay IHT. Yeah. But to get 250 grand, you can only put 20 grand a year in. Yeah. So it's going to take you a number of years. You're going to trade, are you? Trade these or?
Yeah, stocks trading.
Yeah. You can trade them, can you, Chris? You turn it into a.
I'd say you're just moving assets. I don't think you're actually conducting a trade. I don't think you can do that.
But if you're buying and selling stocks and it switches to, that's still
if you're
okay in
an
an ISA.
I think you're okay.
It's fine, yeah.
Yeah, I mean, but an ISA is a big one that they say might change in this budget as well.
The risk is there.
Well, I think it's a lot less risk than a pension. The thing with pensions is they're sort of static, and you can't get the money out until much later, and even later, you wouldn't take all the money out in one go, probably. So it's very easy for them. They can see all this money that is captive, and they can change the rules and grab a load of it. Whereas with ISAs, you can take all that money out if they suddenly made the rules really difficult, bad for you. So they often don't create these big tax grabs on ISAs because you can just sell them and take the money out and you wouldn't pay any tax at that point. But what they might do, what Chris is on about, they might say next year, instead of putting 20 grand in, you can only put 5 in or nothing, or I don't know. But you know what the newspapers talk about? All sorts of stuff that never happens. I'd say over 95% never happens. Yeah. So the biggest risk is not using all of these reliefs whilst they're there. You know, we didn't use our entrepreneurs relief when it was 10 million. It went down to what is it now? 14% at 1 million. We managed to just use it on our 1 million, and we're paying 10% on that. You know, people have been warning for years, oh, this is going to go, whatever. It's not a reason not to do it. It's a reason to get on and do it now whilst you still can, often. The pension thing is different, though, because it's captive. It's a bit like the lifetime allowance. That I think that probably will come back. What's that, 1.1, 1.2 million? And then anything over that, you've got to pay tax on, of the value of the pension. So I'll probably keep ours below that. Yeah.
Yes, ma'am.
Just a query about assessors, because I thought if my husband had the accounting career, so it means querying with him not here, but I thought considering that was that you could actually add value.
I am inquiring about a SAS. One, can you add family members to a SAS? And if me or my husband pass away, is what you're saying I can then avoid inheritance tax?
So are your kids members of that at the moment? Are your children members of the SAS?
They will go and be made members of the SAS.
And then you're going to leave the pension fund to them?
Yeah.
And you're saying that will avoid inheritance tax?
So it used to be the case that if one partner dies, the other would inherit the pension without tax. Is that likely to change?
Likely to change, yes. I haven't looked at it, to be honest. But I think that given what we said earlier, that the government probably need between 4 billion and 32 billion, then I think all bets are off.
You know, when you set a SAS up, so I run our SAS, so there are, you know, you have, each individual becomes a trustee and a member, yeah? So at the moment, I guess you're a trustee and your husband is that right? Yeah. So what happens is each person within that pension has a share allocated to them. And every year you file accounts for HMRC and you sign what percentage of the total capital is each person's, yeah? Yeah. Well, I can tell you that's what happens. So if you now introduce your kids, you can start making contributions to them, 60 grand a year. As long as they earn enough income, you can usually contribute up to 60 grand a year, and you can go back 3 years and all that sort of stuff. So you can start getting money into their names, but your share and your husband's share, you know, that's already in there, the way the rules are changing, that's all going to be subject to inheritance tax. So if one of you dies, and you'll be able to pass it to each other, but not to the kids. That's what it looks like at the moment. But I don't think it's, the detail's still not out, is it? It's still not there. But that's how it looks like it's going to work. Yeah. So I've got that issue. My mum is a member. She's made contributions. So she's got to get the money out now and pay income tax on the money. She can take 25% tax free. So you probably do that anyway. I think it's still 55, but maybe is it becoming 58, something like that?
I think it's 55, but I mean, I think I wouldn't be at all surprised if they tackle that 25% tax free in this budget. So people should be thinking about taking the money out of the pensions.
Yeah, you want that 25% out because there's no tax to pay on it. And then the rest of it, well, you said to me that I probably just need to start dribbling it out to my mum and paying income tax.
Yeah, because the problem you've got is that you could end up with that calculation of 67% if you don't do it right. So you've got to start thinking of drawing it down, and some of these numbers can get pretty big.
We've got one more question. If you haven't got someone else, I thought I'd actually find out a question for her. She, a couple of years ago, inherited a house which has 7 acres of land.
Which has what?
7 acres of land.
Yeah.
She is in the process of selling it. She had just been told by the solicitor that they will take 2 acres and sell 2 acres with the house, and that will be no capital gains or anything, that's her residence, but she will have to pay capital gains.
A couple of years ago, she inherited a house with 7 acres of land. The realtors suggested she put 2 acres of land with the house and sell that, and then sell the remaining 5 acres separately. Should she only pay capital gains tax on the difference between the value of the land when her husband died and what it is worth now?
From when they bought it 20 years ago.
Isn't this what you were talking about earlier, to some extent?
So to start with, what you've got to bear in mind is that you're talking about what's called principal private residence relief.
Yeah.
Principal private residence relief says that the area of land is commensurate with the size of the property. Generally, it's 1 acre. If I own Buckingham Palace, they're not going to restrict me to 1 acre of land. So it depends on the size of the property. If you've got a big stately home, you'll get more than 1 acre with the property. It's by negotiation. Yeah, I know, but the problem is is that if I've got a house there and that much is my garden, the farm is completely separate asset, and that asset will be subject to capital gains tax. The other point you're talking about is it depends who bought the property. If the property was bought by the dad and the dad left it to the wife, and then you might get the spousal uplift, which is that bit I was talking about earlier. So it depends who originally owned the property as to what the deemed market value of that is. It may be that they owned it jointly, in which case her half is the purchase price of the property all those years ago, and his half that he left to her on the farmland may be at the market value at the date of death, in which case you've got 2 different deemed purchase prices.
That's what I said to her. She would probably have to pay the full amount on her half, but not on his half.
The other thing is, have they held it tenants in common or joint tenants? Well, she needs to know all this stuff. Yeah, she probably needs a good accountant to sort it out for her. Because is it the solicitor that's told her this, or who's told her she's got to pay? Yeah. So the solicitor's provided the tax advice. Yeah. Yeah. So you're absolutely right. But the solicitor's advising on capital gains tax. Is that right?
The solicitor just happened to mention to her.
Yeah.
And then they put her in touch with the accountant.
Okay.
And the accountant then
Said this is how it should be.
capital gains tax on the whole lot. And I said, I don't know about that.
No, it sounds like you might. There might be. Yeah. Absolutely. Yeah.
Thank you.
It absolutely does make a big difference. Solicitors also, when you're purchasing, they work the stamp duty out almost always, and I often go away and check it, and they are often wrong. Yeah. 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 She needs a good accountant on it. I mean, the difference is absolutely massive. Yeah, I see this all the time. I've got a mate who's got a business locally, and he's always asking me the same old questions. And I don't even say much now. I'm like, you really need a new accountant, full stop. And that's been going backwards for the last 5 years. And honestly, I think he spent hundreds and hundreds of thousands of pounds of, in tax that he doesn't need to. And that's often...
You can argue your case on the area as well. So you can argue that this property is deserving of a larger area exemption for your PPR relief. The problem you've got is if the garden is demarcated and the garden's all sectioned off, you'll have a harder argument to say that it was that much, not that much.
Is she selling it now? So she's got to, this is the point now, it can't happen in a few years or whatever, or it's not going to happen in a few years, it's happening now. Yeah, so it is what it is. I mean, I have this with, this happens with planning a lot as well. You know, I looked at a site not that long ago and the planning consultant just said, oh, it would be very, very helpful if that just merged into that. Maybe that's what we'll do over the next 3 years. Do you see what I mean? Where the fences come out and, you know, you replant them. Yeah.
There's a little bit with it because she used to, because there were stables there.
Yeah.
She used to do livery for people.
Yeah.
Most of the time they used to have their own horses, they would take them themselves. It's not
Yeah.
where she was involved with. So there is a couple of things which have got livery.
Yeah.
The majority of the land, she just drive. She's driven us around with her tractor.
Yeah.
So there's no, it's all kind of open.
Yeah.
But you sort of got to play devil's advocate because
Yeah.
as far as HMRC, I'd say, well, if you could drive around it, well, how's that? Why is that your own house? What's to say it's not farmland? You've got to make sure that you marshal your argument to your advantage.
And my wider point would be, if people have got this circumstance, living at home, whatever, you need to get on it now. Get the accountant on it. Get him to show you which bits, how it needs to look. And you start now, and then in 5 years, the thing will be mature and it'll be sorted. And then you take photos, you get the evidence together. Once you know, and then you just hand it all to the accountant. The accountant's like, oh, well, that's easy. It's like this, and we'll argue that.
Just a moment.
With a gift, does it need to be officially written down somewhere? Or when you transfer money into the recipient's account, saying gift on the bank statement, is that enough? Or do you need to do it through solicitors?
No, you don't need to do it solicitor. I normally suggest you have something like, Dear Josephine, here's a gift from your loving mother, or something like that. It doesn't have to be great, but the point is, what's to denote it's a gift, not a loan? Because otherwise, just because it's a bank transfer, it doesn't mean it's a gift.
Which
It
put
could be a
gift
loan.
in the subject line.
Yeah, just a simple email that's documented.
Does the gift have to be out of income, Chris?
Well, a gift out of income, you're talking about the 7-year rule. If it's a gift out of income, there is no 7-year rule,
Okay.
as long as it's regular. So in that scenario,
Regular.
If I took my if I drew down £100,000 of pension every year for 15 years, and I gave it straight to my kids, and I carried on working as an accountant, that's a gift out of income. In which case, I document that, and I just make sure that someone knows, because I won't be around when I die. Someone knows that it is a gift out of income, and because I carry on working. So therefore, that 100,000 won't affect my lifestyle because I never had it before.
So if it's a gift out of capital, you can just give it an unlimited amount as long as you live 7 years. There's no
It's got to
IHT.
be a gift out of income. It's got to be regular gifts. So this,
But this is or it isn't.
7 years, then you're right.
But is it
Yeah.
a regular gift or is it
no,
a
it's a
one-off?
one-off. Okay, yeah, you've got to live 7 years.
So live 7 years, no IHT, no other issue. No.
No.
Okay. But is it cash?
Yes.
Yeah. Are you?
There's a bank transfer, isn't it?
Yeah. Okay. Yeah. Okay. That's fine then.
So an email from the father to the daughter, or?
Yeah.
Okay.
That's all it is. I mean, just so there's some evidence to show that it's not a loan.
Okay. Thank you.
If you're giving assets, I mean, I'd love to start giving assets to my son over time, but you have to, even if you just gift them at a zero value, you have to pay capital gains tax on the gifts. Yeah, it's quite annoying.
That's that dry tax charge I explained.
Dan, you've got a question?
I was just going to say something about the land thing as well. I solved the problem a bit like that, whether it worked for your mum, by TP running on the sale a section of land that's clearly not to do with the residents off, and then the bit that was left, I said was all personage. In other words, all associated. So it's a much bigger area than you just said. And certainly, I mean, it's staffing and paying, so it's all gone through in question. So it seemed to me that that's.
With regards to the previous woman's question about selling her 7-acre plot of land, I had a similar situation where I had a large quantity of land which I divided into 2 lots and sold them separately. And that worked very well for me.
I think that's one sale. That's going to be one sale, isn't it?
It hasn't gone through at the moment. It literally is about to queue.
But how many purchases are there?
21 purchase.
Yeah, the whole lot's going as one go.
You can still end up with 2 titles.
Yeah, you can end up 2 titles. It doesn't mean to say they'll agree with it, though.
I was just saying.
Yeah.
My question I was going to ask you, Chris and Mark, is okay. So until Nigel gets in or something dramatic changes, we're all stuck. How can we leverage other jurisdictions, like some friends of mine?
My question is, how can we leverage better tax jurisdictions to mitigate the tax changes we're seeing in the UK?
There's no capital gains tax in Mauritius, if that's why you want to go there. Yeah. So I had a guy at one of these dues, a guy came up to me, he said, I've sorted out my tax. I've got a golden visa, I'm going to Cyprus, and I've got a residency, so it's fine. I said, but that doesn't necessarily make you non-UK resident. Just because you're resident in Cyprus does not necessarily make you non-UK resident. So you've got to deal with the UK tax. You can't just say, I'm going to go and settle in Mauritius, so that's okay. You've got to make sure that you're non-UK resident to sever the UK ties. And you've got to bear in mind there's lots of tails. So what I mean by tail is that if I go to Mauritius for 4 years and sell the shares in my company and come back, they'll give me a tax bill when I end up at Heathrow because I haven't been out of the UK for 5 years. The capital gains tax is 5 years. Income tax is 1 year. Inheritance tax has got like a 10-year angle. So
what's the 7 years then? Why do they talk about 7 for income and capital? Do you think that's wrong? You think it's only 5?
Tax, if you make yourself non-UK resident.
Yeah.
So if I leave the UK today, I've got to be non-UK resident for a full tax year. So I can't come back basically before 6th of April 27. But any income I earn overseas is not going to be subject to UK tax as long as I'm not UK resident. However, if I sold the shares in my company that I had in the UK while I was non-UK resident, that's not effective for capital gains tax unless I'm out of the country for 5 full tax years.
And it can be subsequent to the sale, the 5 years.
Yeah.
It doesn't have to be
No,
pre the sale.
No, as long as you're out for full 5 years.
So 5 years deals with both.
Yeah. IHT's 10, yeah.
But there's other stuff with IHT, isn't there? You've got to move your domicile, and I mean, is that easy?
No.
Could you do it if you're focused on it?
You can do it, but the point is you've got to be non-UK resident for 10 years to avoid UK inheritance tax.
So if you're gone for 10 years, you can pretty much do it, can you?
Yeah, I mean...
Isn't this where you're going to be buried? You've got to sell everything, you've got to...
Well, to start with, there's no such thing as domicile from the 6th of April.
Yeah.
In the old days, you think of Robert Maxwell. Robert Maxwell was born in Czechoslovakia. His avowed intent was to be buried at the Mount of Olives in Israel, where he was. He lived at the largest council house in Great Britain, which is Headington Hall in Oxford, which is now Oxford Brookes University. But when he was UK resident, his domicile, his heart, abode, never resided in the UK because he was born outside the UK and then his avowed intent was to be buried outside the UK. Domicile has now disappeared. There is no such thing. It's just basically residence. You've got to make sure that your residence is out of the UK. But from inheritance tax, there's still a tax tail. So they say you can't just leave tomorrow. And you've also got to bear in mind that if I've got UK property, so from 2015, residential property got reassessed and is subject to capital gains tax if I'm non-UK resident and I own UK property, I still pay UK capital gains tax. And then from 2019, commercial property. So because I make myself non-UK resident, it doesn't avoid a capital gains charge on those assets, even if I've left the country.
What about though if you use a non-UK limited company or other company structure rather than just sitting with your own affairs? Say, for example, if some of your assets are transferred into a bona fide limited company or equivalent in another jurisdiction.
What about if you use a non-UK company and you transfer assets to this bona fide company that has offices and staff doing, say, marketing and research, is there a way you can see the asset and the gain outside of the UK?
So you're still UK resident and you've moved your business to non-UK?
Yes, we would have local directors and premises in that new place.
So the problem you've got there is whether the business is still managed to control from the UK because you're sitting in the UK. That's the angle that they will tackle. Now, if you're saying that it's being run by overseas directors, then presumably you've got nothing to do with it.
I could have a non-executive role and be retained as an advisor.
Well, I mean, if you go down that route, then the question is, where's the board meetings? You've got to have non-UK resident. You've got to be non-UK resident when you have board meetings, things like that. Yeah, I'm not sure. What assets are you moving out of the UK?
It's all hypothetical at the moment, but your presentation, while being very expert, is also very depressing.
Well, the point is, you could hide your head under the pillow, or you've got to be realistic with this stuff. It ain't going to go away, and it's going to get worse. I mean, well, a lot of this is that I think it's Donald Rumsfeld says there's the known knowns and the unknown knowns. It's the unknown knowns that come and bite you. So the idea of this is that you're educated, and then you can react to it. And the point is that I think this situation will get far worse because we owe so much money.
What's a great option?
Anything in another place in the world.
Yeah, you might need to clear off though. You know, as much as I ideally hope Farage fixes all this, I do have a suspicion that he might, if he becomes Prime Minister, he might fix some of it, but a lot of it he'll have to just carry on with. I mean, this. You can't just get rid of a debt of 2.7 trillion and all the other, welfare and NHS and all this other stuff that's completely out of control. It's going to take a hell of a long time to fix it all, isn't it?
Sorry, you've been very patient.
My mum's in Cyprus. She's been out there over 20 years. She's got quite a large estate.
My mum lives in Cyprus and she's lived there for 20 years and has quite a large estate. She has bank accounts in the UK and she's got premium bonds and all sorts of things. I don't know how this works, but is she classed as a UK resident? She still has a UK passport.
Well, the passport or citizenship's got nothing to do with it. It's your residence. So it sounds like she's non-UK resident, and it may be that the assets she's got in the UK are less than £325,000 anyway, in which case she may not be liable to it. So why didn't she just move it all out then? Yeah. Yes. Sorry, I'll be back. You take.
Have you watched Ray Dalio's thing about sort of how countries lose their sort of dominance?
I think I probably did a while ago. I've watched a lot of his stuff, and he's extremely smart. Yeah.
But this situation that's happening at the moment.
Yeah.
Well, they don't need to, because if you go back to my earlier comment, the people paying the higher rate tax are paying more tax than they need to, and they just then deciding that I'm not paying any more, I'm taking my laptop and disappearing. Because if you go back and you think, well, you've got to earn about £70,000, I think, if we assume that each person costs about £20,000, if you earn less than £70,000, you're not even breaking even, which means that the higher rate, i.e. the top 1% pay 29% of all tax, then, yeah. So then if the top rate disappears, who's going to pay the tax? So that's why they say this domicile thing could cost 12.2 billion, because the amount of people that pay the big lumps, the hundred millions of pounds of tax, are disappearing.
From Labour's perspective, that anyone who earns over 30 or 40k should be penalised and punished because they're rich.
Oh, he broad his shoulders. They should pay for everything.
So if you look at it, they were saying that sort of like the domicile situation is a sop to the rich people. But I've got clients who have gone to Portugal, which is non-habitual residency, and they're not going to pay any tax till 2033, no capital gains, no inheritance tax, no income tax. You've got people who go to Italy. So you can go to Italy, go to Milan, you'll pay 200,000 euros flat rate tax. 200,000 might sound a lot, but if you're paying 100 million a year, it ain't a lot. So each America says we're going to have a golden visa. The point is, you want the people who are paying the tax, and you've got to entice them somehow.
I'm next week, tomorrow, I'm going to Portugal, and we're going to stay with a friend, and he has used that non-habitual residence scheme. He got out just before, as they were changing, it was a bit stressful, but I think till 2034 he won't pay, he'll pay almost nothing. He pays a little bit. The only issue is though with that, with Italy, with Spain, big socialist democracies, it works for a while and then it won't work, as happened when they got a new leader. They've already changed it, made it worse, all the rest of it. So they're probably not permanent locations. But he's selling his business and that's what he'll do. But he's gone. He's still got a place here and he comes back. But you do a deal with HMRC, they work out how much stuff you've still got here, and then you're allowed back for between 30 and 180 days a year, is my understanding. So there's a big tick box exercise that you go through. I've spoken to someone who's got to 180 because he's got nothing here. He's got no business here. He's got no house, no nothing. And they're allowing him to come into this country for 180 days of the year. Whereas someone like my friend who's still got a lot of stuff here, I think he's still got his business, all the rest of it, he'll be towards the 30 days, So
you need to tell HMRC that you bring
there's a whole process to go through, isn't there, Chris?
You've got to make yourself non-UK resident. So you fill up the statutory residency test is what you've got to do. Sorry, go ahead.
Hi, Chris. We've got a piece of land near Leeds, 4 beneficiaries, 3 of them trustees. The 4th beneficiary, non-trustee.
We have some land in America which is part of a trust, and the land is now going to be sold. So my question is, how will HMRC respond when we sell that land relating to capital gains tax for the US property?
So then, for those of you who know Boris Johnson, you may be aware that he was born in New York. He sold his principal private residence to the UK when he got divorced from his first wife, and he ended up paying tax in America because he got a green card in America. So
he was never that smart with stuff like that, was he? I mean, 7 kids that we know about. And,
I think it's 9.
It's 9, is it?
I think it's 9.
I mean, he won't have even thought about that, will he?
But you need American tax advice as well as UK tax advice for that person.
Which is what we've told them. But in terms of the UK,
As UK residents, do we need to be concerned as to how the property is split up amongst the other trustee holders?
How do you own it? Through a company or your own name?
we all own it.
You're joint owners.
We're all owners, and
It's registered at Land Registry with 3 trustees, but that doesn't make us legal owners. It's just a very simple trust naming us as trustees.
Their trust.
So have you got a trust agreement? Have you got? And does that say how the ownership is split, how the capital is split?
It usually would.
Yeah, because it's changed over time, so it's that the will trust that pay into that trust, they all sit behind it, so we can back one of the
The trust has changed over time. At the moment, one of the trustees is going to work out an equitable share for the other trustees this weekend.
because otherwise.
Well, I mean,
Well,
you're getting a bit of a bum fight with HMRC.
they're not squabbling over
No, we're not
who owns.
swapping,
No.
that's
No, we're not squabbling. That's why we're going to do this piece of work this
Does
weekend.
it get the share get changed because of different people put different amounts in, or?
no, the shares will be fine.
Okay. Well, surely that's simpler then, isn't it?
It just comes
Yeah.
through the wills into the trust. It's fairly
Yeah, well, that's probably.
I always prefer these things to be explicit rather than implicit.
Yes.
So that if it's explicit, you've got a document. If there's an argument with HMRC, you've got a document you can show them.
So we could just do a standalone document and get it certified by solicitors and have a look into it, something like that.
I don't see why not. But I mean, you all agree who owns what, because you'll need that for when you do your calculations anyway.
The US person, there's a double taxation treaty, isn't there? So what will probably happen is they get taxed in the US according to the rates in, and it'll be probably, well, they might have state tax and they might have federal taxes as well. I mean, it's not in California. I was there a few weeks ago. It's, okay, I think Florida is a lot less than California.
I don't know there's any state tax.
I mean,
There's only
for
federal
example, in California, you pay tax when you sell your own home. You pay capital gains tax. You pay all sorts of taxes. It's worse than it is here. But yeah, Florida's probably a lot better. So they'll probably just pay, if they're resident, they'll probably just pay their tax in Florida and then probably won't have to pay anything here.
Is it just land?
It's just land, but it'll be sold for residential property development.
Well, in 2015, residential property is subject to capital gains tax regardless of where you live, and 2019 is commercial property. So it may be that there's tax assessed here, and they just don't have to pay any more over there.
Oh, so you pay it here and not over there? Yeah. Well, it sounds like they might have to pay here, actually, and then that gets offset against anything that they would have paid there, which might be a higher
Yeah,
rate.
it's their issue.
They need to get an accountant.
They won't get a refund over here, though, if they've got less tax in America.
And they're going to need an accountant here and there. You find them an accountant here to deal with here, and then they need one there as well, and then they both need to talk to each other.
You done? Run out of questions.
Wow, no more tax questions.
Done all.
Oh, there's one over there.
Why wouldn't everyone? Well, what asset have you got to put in it? Some people haven't got assets to put in them. What assets do you want to put in an FIC? Properties. Are they owned in your name? So then, if you move it from your name into the FIC, the chances are you'll crystallise again. Against what? No. It's a capital gain. Can't offset a capital gain against the director's name.
And maybe stamp duty as well.
I mean, a lot of this stuff is that you've got to be careful you're not crystallising gains. You're jumping out of the frying pan into the fire. You've sort of got to decide why you want to do it. And if the idea is to take it out of your name personally to put it in FIC to give your kids an interest in it for the sake of argument, then why don't you just give them an interest rate in the property?
What you might do is set up the FIC and then buy properties. You know, that limited company then buys the properties directly in. So for me, I may just leave everything as it is, but then future stuff I put into that sort of entity for the benefit of my son, because I don't want to pay a load of capital gains and stamp duty and everything like that at the moment. I may clear off in 20 years, and at that point I may do some transfers and other stuff. You know, there's probably more options, but I'll have to clear off for a significant period. Yeah.
Yes, sir.
I'd like to ask about the incorporation thing.
For what? That gentleman? That guy? He's got two properties. So you're trying to invoke Section 162 incorporation relief. Moyne Ramsey is the case. But you won't do it with two properties.
My brother has an estate with 6 properties on it.
And what does he want to incorporate?
He wants to hold over any capital gains and hopefully negate inheritance tax.
And who does he want to leave the properties to?
Hopefully me.
So is there any detriment in him giving you a share of that now, those properties, rather than put them in the company first? I mean, the problem you've got is less tax for landlords, property 118, that caused something called Spotlight 63. Spotlight 63 is just think of a torch shining a light. HMRC have this thing called Spotlight, and they sort of say this is the bits we don't like. Spotlight 63 is response to that. My understanding is that Chris Bailey, who set up Less Tax for Landlords, has been made bankrupt. HMRC are going through that. We've got some clients that are being investigated that we've taken over, who was set up by Less Tax for Landlords, and there's big inquiries. And the problem you've got with a lot of those is that if normally the limited company is a partner in the LLP, so income is going in the limited company, and they're saying we want to unravel it and we want to tax the property income on you personally. The problem you've then got is HMRC aren't necessarily giving you the relief on the corporation tax you've already paid out of that limited company. So there's a GAR and there's a lot of more avoidance. It's harder to do this now than it was before because of that.
But 6 is probably all right as long as you refinance all the mortgages. And
6 is okay, but I mean, are you going to go from a sole trader in your dad's name to an LLP to try and mitigate SDLT to a limited company?
Yeah, no idea if I get some proper advice.
Okay, so now there's the set that used to be, well, you could go to an LLP to try and mitigate the SDLT, and people said you could do it 2 years. Now it could be a lot further, because some people are saying it could be up to 7 years. And then you've got the property in there for 7 years, and then you go into a limited company because you want to avoid capital gains tax and SDLT. That would be your aim. The question is, all I'm saying is it's harder to do that now. Well, anything's possible. It's just a case of how long it takes and whether there's an easier way of doing it. So a lot of the stuff is that people come to me and say, oh, I want to go from there to there. And I said, but do you really need those bits in the middle? Because it might just mean there's more chance of HMRC tax in there.
I think there's people still doing the 162 on that many properties, aren't there? You might have to pay the stamp duty.
Stamp duty could be a lot.
Is it in one name?
Yes.
Yeah.
So all in one lump, or could you do it actually?
Well, it's better probably to do it. I mean, you might get out of the CGT, but the stamp duty sounds more difficult now, doesn't
So
it?
the problem you had is that the first tier tribunal, Elizabeth Moyne Ramsey had 10 properties, of which 5 were let out. I think they're in Ireland. And at the first tier tribunal, the judge said, you can't do section 162 because it's not a trade. And if it's not a trade, you won't get business property relief. Then that was challenged. It went to the upper tier tribunal. Judge Berner listened to that and he said, look, I don't quite understand that because it doesn't have to be a trade, it just has to be a business. So business isn't defined in the Taxes Act, trade is. And I don't know what you're talking about business property relief. Business property relief is an inheritance tax relief. This is capital gains. You pay capital gains tax when you're alive, inheritance tax when you die. So it's not business property relief and it's not a trade that I'm worried about. And that's why the Elizabeth Moyne Ramsey case succeeded, because she met these certain criteria. And the question is, if you look at a sliding scale, if I'm an accountant and I own one property that's managed by someone else, that can't be a business. I've got some clients with 63 properties. So where on that scale does it become a business? And that's the bit you've got to get past.
And if you imagine many others in companies that's disregarded, it's the 6 properties that you're actually in your personal name that have to be.
No, I mean, I've seen ones with less. You could have an HMO that's got 6 tenants in one property. So that it doesn't necessarily mean that's the be all and end all.
And would one of someone
So would having more than 6 service properties make a difference?
So the legislation for serviced accommodation and furnished holiday lets has changed. What is very interesting is that that it hasn't changed for VAT. So for VAT, you're still subject to the furnished holiday, you're still subject to the old VAT rules, even though the income tax and capital gains tax rules have changed. So in which case, what I said about the thresholds of that would affect you with FHL if that was changed.
Yeah, I've got one of those games, my personal
Well, hopefully someone more mortal will tell you, rather than God.
Yeah, I'm going to be according to that.
One last question.
Just a quick question. My parents sold their property in France a couple of years ago, and they had to pay a huge amount of tax in England and in France. They used one French solicitor and one English accountant. Should they go back, as you said to that lady over there, should they go back to another accountant in France to see that the tax they paid was correct, as the amount was huge?
So I've got a client that's got a property in France that's worth about £3 million, and he pays the wealth tax on that property in France. So I don't know if they actually suffered the wealth tax as well, but, sorry? I don't know what the wealth tax is in France, but they're paying over 20,000 euros a year on the wealth tax, let alone the capital gains tax they'll pay in France. But I'd always suggest you get a French accountant.
Why do people do this? Why don't they just fucking rent them? I mean, it depends how long you go for. If you're there for a long time, of course, but I don't get it.
So what
Spain as well, it's similar. I mean, was it? I mean, my pal's got one in Spain, and actually it's Ibiza, and it's 4 million or something, and he can't rent the bloody thing out because of these problems. And if I want to go over there, then he sort of lets me go, and but it's a bloody nightmare, and you can rent the whole thing for 20 grand for 2 weeks,
So
and now he's got the bloody neighbour taking legal action against him because the swimming pool leaked through their wall or whatever, and this German neighbour's gone, no, we'll go to court, whatever. So he's got to deal, and he's flying back and forth to deal with that. And every time he goes there, the first 3 days are just dealing with all the bills and all the paperwork, the legal dispute, and then the tax, and then I don't get it. Yeah.
So he came to tell me this 2 weeks ago. We were talking about inheritance tax. So the mitigation is we're going to give the kids a quarter. So mum and dad have a quarter each. Kids have a quarter each, which mitigates IHT, and he doesn't pay any wealth tax because there's 4 owners rather than 1 or 2. So
it's really important to get the right accountant on it. I'm sure there's a big disparity in France as well between their HMRC equivalent officer accountants, the ones that just send them all the money, and then the ones that actually think this stuff through and find a way to deal with it.
And if there was a mistake, is it possible to go back and appeal, or is it a lost cause?
He probably doesn't know because
I don't know about French tax.
You're talking about French legislation, which will, I mean, there's 50,000. How many pieces of tax code are there in this country?
Oh, that high?
Yeah. So in France it'll be. I bet it's the same, if not worse. So he won't know. You've got to find one there that knows all the details. If it was here, could you get the money back?
You can go back up to 4 years for if there's an error, and that's you got to do it manually. You can't do it online. So you can go back if there's an error, justify it.
So you might be able to then. I mean,
in the UK, but not. I don't know in France.
You know what? ChatGPT might give you a response. It might do. I don't know. It might not be right, but something like that is worth. Yeah. Okay, I think we're done.
Okay.
Thanks very much, Chris. Big round of applause.